Okay, good morning, everybody. I am going to get started with a few housekeeping items as people keep coming in. Welcome to the Lumsden McCormick webinar, Fiscal Year 2022, New York State Budget, the good, the bad, and the ugly. My name is Christine Prue, and I will serve as your host for the webinar today. But before we get into introductions, again, I have a few housekeeping items. This webinar is being recorded, and we will share the link with all attendees once it is on our website, along with the slide deck. Both the chat feature and Q&A are enabled. Please type all questions that you may have for the panelists into the Q&A specific section to ensure that our panelists see them. We will be answering your questions throughout as we reach breaks with polling questions and again at the end of the webinar. Now moving on to CPE, we are offering 1 hour of CPE credit for this webinar. Therefore, all polling and survey questions need to be answered. We will have 4 polling questions during the presentation, and you are required to answer 3 to qualify for CPE credit. You'll be prompted for each and results will be shared. At the end of the webinar, please complete the short survey, which will automatically launch. The survey will serve as the webinar evaluation and again is required if you are requesting CPE credit. 1 hour of CPE will be issued for all CPAs. We will email you a certificate in the upcoming weeks. Certificates are going to be emailed through Prolera, and while they will say that they are coming from Lumsden McCormick, the email address will be support@prolera.com. I will also put that in the chat so that you can reference it and make sure that it does not go to your spam folder. As many of you already know, this is the second part of our 6-part webinar series on legislative changes. Again, see the chat for a link to read about and register for the rest of our upcoming webinars. The link will also be provided in the follow-up email that we send. Now, before turning the program over, we're going to launch our first polling question. So are you attending this webinar to earn CPE credit? If you are, please be sure to answer yes so we can make sure to get you those CPA or CPE certificates. Okay, we'll give it a few more seconds while those last few votes come in. Okay, I'm going to close that out. Okay, now I am going to turn our program over to Carrie and Mark, who are both principals in our tax department. Take it away, guys.
Awesome, thanks Christine, and welcome everyone. Thanks for spending the next hour or so with us talking about the New York State budget. So as we were preparing the presentation, trying to come up with how we were going to present everything, we thought the theme of the good, the bad, and the ugly was fitting for this year's budget, complete with sound. Really looking at the stratification of the budget. This is a high level what we're going to get into today. Starting with the good is the PTE credit. So the pass-through entity credit, which is the SALT cap workaround, that $10,000 limitation on Schedule A itemized deduction. So there was some guidance and program that came out through the budget. And so we'll get into the details of that. I think that was really, the meatiest project that came out. So we will spend a fair amount of time on that today. Also wanted to get into some additional programs that came about. So the individual property tax credit that's now available, some additional state programs, both new programs and extension of current programs, and middle class tax cut rates. So that was all the good. Moving over to the bad, there were what New York State is calling the wealthy and ultra wealthy tax rate increases. So those are on the individual side, and then there was also some corporate tax rate increases, as well as the capital-based tax changes. And then lastly, we'll end up talking a little bit about the opportunity zone decoupling, which we put into the ugly category.
So as Carrie mentioned, I think the pass-through entity tax election is probably the biggest tax consideration in the budget. Probably could provide a significant benefit for the proper entity. And this is something that all of our clients that are flow-through entities should be looking at in conjunction with their advisors to figure out if this makes sense for them. So what is the purpose of this pass-through entity election? Essentially, it's a workaround for the SALT cap limitation at the individual level, the state and local tax limitation for your itemized deductions. And why now? The IRS has come out with this notice 2020-75 that essentially gave the okay for states to put this type of legislation in effect. And we'll get into exactly what the pass-through entity tax is, how it's calculated, how to make the election in a second. But first, let's talk a little bit about the federal SALT limitation to give it a little context. So this was a limitation that was part of the Tax Cuts and Jobs Act of 2017. Prior to this, when you went and filed your personal income tax return, you either took a standard deduction or you took your itemized deduction to reduce your total taxable income. The itemized deduction is it's comprised of several things, but the major three are usually your SALT, your state and local income taxes, your state and local taxes, I should say, your mortgage interest expense, and then charitable contributions. So prior to the Tax Cuts and Jobs Act, if you were someone with a flow-through entity and you paid a lot of income taxes at the state level, you generally, as long as you weren't an AMT, saw a benefit for those state taxes that you paid in the form of a federal tax deduction, reducing your federal tax income and liability. But with the Tax Cuts and Jobs Act, what happened was, although they doubled the standard deduction, essentially, they put a cap on that SALT deduction, on the itemized deduction calculation of $10,000 for married filing joint. So in essence, for a lot of our client base and a lot of business owners, now the taxes that they paid to New York State, they received no benefit for virtually. So the SALT limitation as part of the Tax Cuts and Jobs Act is in effect through 2026 currently. New York State has tried to circumvent this issue before. If you remember, shortly after the Tax Cuts and Jobs Act came out with this limitation, New York and several other states toyed around and tossed out the idea of setting up these charitable funds where taxpayers could make voluntary contributions to these funds that go to the state, and they would receive a benefit at their individual tax return in the form of a credit. And the IRS essentially came out and said that's not going to work. But now with this notice 2020-75, this is a workaround that the IRS has given their blessing to.
And something to note as well, that $10,000 SALT limitation, it's both, New York State or state income taxes, but it's also property taxes. So, living in New York State, having the higher property taxes, you're really kind of being cut off at the knees because you don't get the benefit of those deductions. So this program is kind of a way to bifurcate that and still get the benefit for the property tax deduction, as well as the income tax component too.
So how does this work and what's the treatment? Essentially, if you have a pass-through entity, and we'll talk about the eligible entities in a second, you can make an election at the state level. You will end up paying a entity level state tax, and that becomes deductible for federal purposes. So now at the entity level, you'll get a deduction for those state taxes that you're paying, reducing your flow-through income for federal purposes. And the partners and the shareholders will get a proportionate share of a New York State tax credit. So when they go and file their New York State returns for the taxes, their share of the taxes paid, the PTE taxes at the entity level, they'll get a New York State credit to offset their tax. And if for whatever reason they pay more tax at the entity level than their taxable, their tax liability becomes when they go and file their personal return, they'll be entitled to an overpayment that would be refundable. So who is eligible? It's generally partnerships, LLCs taxed as a partnership, in New York State S corporations. And those are corporations that are treated as S corporations for New York, they don't necessarily need to be domiciled in New York State. So there's a few mechanics in one of the themes you're going to hear us say probably a few different times is there's a lot of unknowns with this. It's relatively new, how it's going to work, what forms to use, what information is going to be required, how the state's going to treat it, how other states are going to treat it. those are all unknowns that we'll talk about again, but just something to keep in mind. So I'm sure there's going to be a lot of questions. And at this point, the answer is probably wait and see. But New York State is expected to provide additional guidance in the next coming months on some of these things. So there's an annual election that's going to be needed to be made by the entity. And that's going to start for the 2021 tax year and going forward. Starting in 2022, that election is going to be due by March 15th each year. For 2021, since the budget was just passed in April, they're giving you until October 15th of this year to make that election. A quick note, it's irrevocable. Once it's made, it's made. There's no going back and amending or changing that election. So you really want to make sure you run the numbers here, make sure it's something that the entity wants to do. Once the election's made, it's going to include all of the eligible partners because it's at the entity level. And there's going to be quarterly estimated tax payments required starting in 2022 as well. Similar to the individual side and the corporate side, it's also going to be based on either 90% of the current year tax or 100% on the prior year tax. Just an odd item for fiscal year filers. Generally, they're going to have different due dates than calendar year for regular tax returns and filings, but for this program, they're essentially put on a calendar year basis as far as due dates go, not your accounting period, but the actual due dates of when you're going to file. The timing of your elections, when the returns are going to be due, when the estimated tax payments are due, those are all going to have the same due dates as the calendar year entities. And I think one of the biggest things you want to consider before making this election, second to whether or not it's beneficial in terms of dollars and cents, is that amended returns, if you make this election, would need the commissioner approval before being filed. Currently, you can pretty much go back and amend returns without the commissioner consent, but under this program, you'll need to get that, you'll obtain that consent before you can file an amended return. So if we see tax law changes after the fact or retroactive that could be beneficial and we've made this election, well, now it's just another hoop to go through to make that amendment.
And also worth noting as well, to Mark's point, we don't have the specific form number or have seen a form as to how this election, what this election is going to entail. It will undoubtedly, include partner information, credit allocation, if there's disregarded entities, probably, really the mechanics for New York State to be able to say, here's the entity paying the tax, here's the return that it's going to end up on, and to be able to flow through that credit. So we unfortunately don't have that information right now. Again, hoping in the next few months to have some more concrete information on what that form is going to look like.
So what's the tax base and how is this tax going to be calculated? It's very similar to the allocation and apportionment rules as they are currently. So for partnerships, it's going to be your New York taxable income that it's attributed to the New York State resident owners. And it's going to be the New York source income that's attributable to the non-resident owners. It will not include any income that's eligible to a corporate partner. For S Corps, it's only income derived from your New York sources, even for resident shareholders. So this seems to be the big difference between the two. For partnerships, if you have a resident owner, based on what we've read, it sounds like the tax base is going to be all of the taxable income. So as a resident, you pay tax on all of your income. But for an S Corp shareholder, it's only going to be the New York State portion of that entity's activity. Even though when you get to the personal level, that S Corp shareholder is going to pay tax on their total income. So there's, based on how it's written, the S Corps could run into a little bit of a disadvantage compared to a partnership here. Just something to consider, and hopefully more guidance is going to come out on that.
And to get into some of the why on that S Corp thing too is really the IRS didn't want there to be any argument that there was different classes of stock within the S Corp. So if you have resident and non-resident partners and New York resident partners are having additional withholding or something, there could be the argument that they have a different class of stock than non-resident. So that's kind of the whole reasoning behind that. But, you know, as Mark said, that could leave room for error on the New York return, or room for additional tax payments to be required at the individual level.
So here are the tax rates. So for the first 2 million, it's at a rate of 6.85%. The next 3 is at a rate of 9.65%. The next 20 at 10.3, and then anything over 25 million is at 10.9. And we're going to get into some of the individual tax rate changes in a little bit, but essentially for those higher income earners, these tax rates mirror what's put in effect for the individual side of things. So we wanted to illustrate maybe a quick example to show potentially how powerful this could be in the right situation for the right entities. So on the left, we have an example where there's no pass-through entity tax election made. On the right, they do make the election. So we have a partnership with 3 partners. It assumes they're all a third in ownership, in allocation. It also assumes that they're all New York State residents and all their activity is New York State sourced. That's not going to be the case with everyone, but just to make a point here. So the entity, their partnership income is 1.5 million. They're allocated 500,000. They have no pass-through entity tax deduction in scenario 1. We're assuming a 37% rate for their federal individual income tax liability. For state taxes, we're assuming a rate of 6.85%. So in scenario 1 on the left, their total tax per person is about $220,000 between fed and state. Scenario 2, the exact same facts, except that they do make the pass-through entity election, the tax election. You can see on that third line down, they've got a deduction for the state taxes at the entity level, reducing their taxable income for federal purposes from $500,000 each down to $465,000 or $466,000 roughly. So their federal tax liability is now based off of that $465,000 instead of the $500,000, resulting in a lower federal tax liability. Their state tax liability is going to stay the same. New York and other states aren't going to allow you to take the deduction and then also get the credit. So it's going to be an add back. So for state tax purposes, the liability doesn't change. But at the federal level, you get the benefit of making that election and taking those state taxes as a deduction. So all in, per person, their liability in scenario 2 is about $200,000. So in total, that's about a $38,000 savings. So again, this isn't to represent all of the client base or your individual facts and circumstances, but just to illustrate how powerful this might be for the right entity, the right activity.
So kind of getting into some of the questions, you know, the unknowns, additional considerations, and just talking about the program in general. Really, you know, as we just saw in the example, it can definitely be a powerful tool. If you have an entity that has any kind of multi-state impact, whether that's owners who have different residency, whether it's business operations in different states, the biggest takeaway from this that we want to stress is the modeling out of what that's going to look like and understanding the state impact for each state and each partner. So, you know, that was a very simple example. Unfortunately, the real world isn't always that simple. It'd be great if it was. But, you know, that's where you really should be relying on your tax professionals to come up with those models and those state impacts. For cash flow purposes, you know, another reason you'd want to model everything out, making sure that you have adequate cash flow to make the estimated tax payments timely, which would follow, you know, the individual tax payment timeline. So March, June, September, January. And again, the impact on non-resident or even ineligible owners. If you are an entity and have a corporate owner, there's additional impacts and additional considerations to come out of that analysis as well. So kind of moving on to the next point, the multi-entity election considerations. So this is really getting at, if you're an investor and you have, let's say, 5 different K1s that you get every year, taking the consideration, you know, and seeing which entity is going to make this election. Are they all going to, or none of them going to? really, wanted to stress the importance of projections and planning at that level. Obviously this is all going to end up on an individual's tax return. So doing the analysis and the planning at both the entity and the individual level to make sure that the intended consequences, kind of shake out how you want them to. Obviously, you don't want to way overpay your New York state tax and have every single entity making this election and withholding, because then your New York state return is going to be way overpaid and you're essentially giving New York state free money to hold on to. So really, the importance of projections and planning, both at year end and throughout the year, because as Mark mentioned, this election is due March 15th. So in years after 2021, this year is a little bit of an anomaly. We have the benefit of having, 9 months of activity to say, what is the year maybe going to look like? Is it income? Is it loss? Where are things going to shake out? Before we have to make the determination, yes, we're going to pay the tax at the entity level. Fast forward to next year, this election is due March 15th, and that's the only time you can make it. So, all of these things go into that consideration, but particularly so when you have multiple entities is really just what we wanted to stress there. So one of the big questions is, how is New York State going to treat other state payments? There's about 13 states that have passed this PTE legislation in accordance with the Notice 2020-75. Within those states, there's kind of two different regimes or two different buckets as to how states are going to show this tax and pay this tax. I would say the first bucket is similar to New York State. The entity is going to pay the tax. It's going to come out on the K-1 as a credit to the individual. The individual takes the credit. That's where, the overpayment is going to live. That's all great. The other bucket, the other group is more of a, probably more closer to like a composite payment where the states are assessing the tax on the partnership. The credit may or may not come through on a K-1 to a partner or a shareholder. So the real question is New York State going to allow a credit for those other taxes that may or may not be on a K-1? The way the legislation is worded currently, New York State is going to allow a credit for anything that is substantially similar, a substantially similar tax payment, but they have yet to define what that is or definitively say, yes, if a state is abiding by, the IRS notice and it's okay by them, then it's okay by us. So something we're definitely keeping our eye on, and we'll, send out updates as they're available, but it is an unknown at this point. So the next point is cash basis considerations. So if you're a cash basis taxpayer, there's even more modeling and even more additional considerations to take into account, namely because that fourth quarter tax payment isn't due until January 15th, that estimate. But in order for it to be deductible to get the benefits that we just saw in the example, that payment now needs to be made December 31st. And if you remember or want to rewind to before the Tax Cuts and Jobs Act, it's the same kind of methodology there. When you had the SALT, deduction, you needed to make your estimated tax payments or your state tax payments by the end of the year. So we're going to see, I think, that December 31st date really come back into play in terms of timing for deductions and when entities will be able to take that benefit. So next, if you're a shareholder or if you're a partner in one of these pass-through entities that's making the election, just being aware that you do have the ultimate liability for any taxes paid. So if there's unpaid PTE, there could be additional considerations in that regard. If there's overpayments, so back to my scenario when you had multiple K-1s, you had all of them withhold, and now you have a huge overpayment on New York State, that payment is going to be taxable in the following year, similar to, again, rewinding to the pre-TCJA, when you had tax refunds. If you're receiving a federal benefit, so if you're receiving a federal deduction for a payment and then you get a refund of it, it would be taxable in the following year. So that is something to consider as well. And again, why you may not want to have every entity you own do this PTE election. So the choice of entity it can come into play if you are, let's say, an individual that has a Schedule C or has a rental property on Schedule E. Those entities are not eligible for this election. So does it make sense to maybe check the box and make it an S Corp or convert it to a multiple entity LLC? Those are all kind of considerations and things to think about as we learn more about this program and kind of, you know, go through the motion of what this is actually going to look like. And then lastly, the potential elimination or expiration of the SALT cap. We certainly don't have anything concrete on this. I think there's been some chatter in Washington about potentially eliminating it. Nothing concrete that has come out of that. The SALT cap is set to expire in 2026. So who knows where this program is going to be then, or what's going to happen when it expires. But we've got a good 5 years before that happens. I have no doubt that there'll be a lot of developments between now and then.
Just two quick things if I could. So back to the planning, when you have ownership in multiple investments, sometimes they're all within the same firm and the same accountants handling all of those, but a lot of times they're not. You might have one accountant handle this real estate entity, a different one handle your individual return, a different one handle an operating business, and so on and so forth. So I think if you're looking at this election, it's even more crucial this year to make sure everybody's on the same page and working in conjunction than in the past, because you want to look at the whole picture. As Carrie mentioned, all of this is going to end up on the individual return. You want to make sure that everybody knows who's on first. And the other item was there is some language that there might be extensions available for making this election, but it sounds like similar to the amended returns, you would need to go and get the approval directly from the tax commissioner. How that's going to work and what you need to submit. We're still waiting on guidance for, which is something to keep in mind.
I think we'll check in on the questions and see if anything's come through. Doesn't look like there's been anything. Certainly if you guys have questions, there'll be, we'll have time at the end as well. To get into any of those, but I think we'll do a polling question here next. And in the spirit of the New York budget, we wanted to keep it all in New York State. So in what year was Letchworth State Park named the best state park in the country? 13, 15, 17, 19.
Okay, we'll give it a few more seconds.
Awesome. So 2015 is the correct answer for that. And it looks like we had about 34% of people answer correctly. So interesting facts for the day anyways. So next we'll get into, perfect. So next we'll get into still in the good category, but some additional programs from the budget. There is a property tax credit that's now available to homeowners, and it is on your primary residence only. So any secondary residences wouldn't qualify, but if you have New York qualified AGI that is less than $250,000, and you're paying property taxes in excess of 6% of that, then you would be eligible for this credit. The credit is capped at $350 a year. That is not a typo, and it is certainly not a windfall, but we will take what we can get this year. And that is an eligible credit for 21, 22, and 23. So moving on to some additional programs. So these are all new programs that came about as a result of the budget. There was about $1 billion in financial relief for small businesses in this year's budget. And this is, there's some of them included here. So the Small Business Recovery Grant Program was a big one that people were excited to see. This program was allocated about $800 million of the funding, and it is administered by the Empire State Development Corp. So it's really aimed at small businesses that have 100 or fewer employees, was in existence prior to March 1st, 2020, was obviously negatively impacted by the pandemic, and then they weren't eligible for federal grant assistance, or that assistance wasn't sufficient to cover everything they had going on. So that's kind of the criteria for that program. Another new program that came about was this restaurant return to work credit. So this is a $5,000 credit that you're eligible for every new full-time employee equivalent. So the credit is capped at $50,000 per entity. So if you're a restaurant and you're hiring 10 new people, it could be a substantial amount of that $50,000 credit. There's also a music and theatrical production credit. So this credit was available for New York City region, but with the new budget, it was extended beyond that region for an additional 4 years. So that credit's eligible through 2026. And this isn't necessarily a credit, but something we just found interesting is that with this year's budget, the legalization of mobile sports wagering happened. They are still in kind of the development phases of what that's going to look like in the programs that will be eligible for that. But it is expected to raise, about, I think it's $500 million to help offset some of these credit programs. So these are all existing programs that have been extended or enhanced with the budget. So the Brownfield program credit has now been extended for an additional 2 years for any redevelopment projects that were subject to delays because of COVID. The Empire State Film production and post-production credits are now extended through 2026. And I know we have a number of clients that have taken those. So we thought that was interesting and certainly worth mentioning. And then lastly, the Excelsior Jobs Program investment tax credit. That really has expanded its definition of expenditures that are eligible, really honing in on the eligibility of childcare services. So that's eligible for the 5% credit. They also created the Excelsior Child Care Services Tax Credit. That is a mouthful, as part of the budget as well. So we are still awaiting a lot of guidance on New York State on those programs. Again, things to be aware of if those are programs that you may be eligible for, you're interested in. Again, we have clients that take those credits, so definitely within our realm of experience here. And again, that Excelsior credit is extended through 2026.
So some of the good and some of the bad are with the individual tax rate changes. So the first is the middle class. They're going to see a moderate tax rate cut, nothing enormous, but a tax rate cut nonetheless. And then what New York State is referring to as the wealthy and ultra wealthy, they're going to see a tax rate increase. So these are technically retroactive, starting for 1/1/2021. So those individuals will feel the effects of that this tax year, and those are set through 2027. And here's just a table that shows the rates. Those boxes in that yellow on the right side show what has changed. As you can see for the middle class there, a slight decrease. The income over $1 million for single filers and married filing joint at $2 million, a pretty significant increase actually. For those over the 25 million, that's about a 20% tax increase. And to Carrie's point earlier, we were talking about this. If you're in New York City, you get absolutely hammered with a state and city tax that's one of the highest in the country, if not the highest. So pretty significant on the higher end of things.
And something we also noticed that was interesting is that once you get to that $2.1 million as married filing joint, there's no kind of difference between the single status and the married filing joint. They're taxing everybody at the same kind of rate brackets. So I feel like a good CPA presentation wouldn't be one without some charts and rates. So
So the bad on the corporate tax side, not great news. We've got an increase to both the corporate income tax rate and the capital-based tax rate. The income tax rate, you got an increase of 6.5% to 7.25%. Not huge, but an increase still. But that's only going to apply to those corporations with New York State business income tax base of over $5 million. Those corporations under that are going to still pay that 6.5% income tax rate. In the capital-based tax rate, that was originally set to expire as of 2021, but it has been reinstated or extended through 2023. That is a tax that's based on your business capital apportioned to New York, essentially your assets less your liabilities times your New York State apportionment percentage. That rate is 0.1875%. It doesn't apply to your qualified manufacturers, your emerging tech companies, or your small businesses. But both of these are temporary through 2023. But who knows what's going to happen from now until then.
it's the Wild West, if you will.
So another polling question here. What is New York State's state bird? I didn't know this one.
We have a few more votes coming in, so we'll give it a second. I don't think you're alone in being the only one who didn't know this,
I
though.
was just going to say, I'm curious to see what the results here, if I'm just
It's probably the most exciting part
the
of the
dumbest person in the room or
Okay,
educational.
yes. I'm going to close out polling and let's see these results.
Oh, so it is the Bluebird.
50%.
50%. There we go.
That's pretty good.
Yeah. Awesome. So moving on, unfortunately wrapping up with the ugly. So we put the Opportunity Zone program here for reasons we'll get into. But before we really get into the New York State aspects of it, we wanted to kind of back up and do a high level of what the federal program is to understand the impact in New York State. So this first slide here is all the federal program, and we're not going to get into the nitty-gritty details of it. We could do an entire CPE, I have no doubt, on just the Opportunity Zone program, but really high level, it's a three-prong benefit program. So the first benefit is this deferral. So if you are, an individual or an entity and you have capital gains, you want to invest them in a qualified fund, you do not have to pay capital gains tax on that until 2026. Again, this is federally. The second benefit is a reduction benefit. So when you do have to pay tax on them in 2026, if you've met certain holding requirements, you would be eligible for a 10 or 15% reduction of those capital gains. So instead of, if you have gains that you're investing in 2021, you would meet the holding requirement for the 10% reduction. You would only have to pay tax on 90% of your capital gains. So that's really the second benefit of the federal program. And then the last benefit is this exclusion. So again, you invest your money, you meet all your holding requirements, you pay your tax on your gains in 2026, you hold your investment for 10 years and sell it before 2047. You would be eligible under the federal program for a full exclusion of any appreciation on that investment. So we've definitely seen, a lot of interest in this area. We have clients invested in this area. That exclusion benefit, I think, is one of the best benefits of the whole program and can certainly be very valuable if you get money into an investment and it does really well. So what exactly did New York State decouple So they really pulled away from the first two benefits of this program, which is the deferral of payment until 2026 and that reduction, that 10 or 15% reduction. They are still allowing the exclusion benefit. So on the back end, when you sell your investment, and if it's a qualified investment and meets all the tests, then New York State, as of now, is still allowing that exclusion, but they are not, abiding by the deferral. So New York State is going to say you recognized capital gains in 2021, and that's when you're going to have to pay tax on them for New York State purposes. So the reason we're calling this ugly is because this is really another retroactive change that has come out of the budget. So it applies to any capital gains that are recognized in 2021. Again, the reason we're calling it ugly is because somebody could have, between January and the time the budget passed, which was mid-April, recognized capital gains, had full intent to put them into this program. We're getting all these great benefits, and now New York State is going to say, just kidding, you don't get all those benefits. You have to pay tax on it. You don't get the reduction, but you still get the deferral. So that's, something that we saw. New York State is not the only state that is pulling out of the Opportunity Zone program. There's not a ton of them, but we're not alone. So California, Mississippi, North Carolina, and Massachusetts have all decoupled from the Federal Opportunity Zone program. One other thing to note as well is there could still be overlapping timelines in 2021 where, if you're receiving gains from a K-1 investment, or you had a gain that was recognized in late 2020. Again, there's timelines that we're really not going to dig into too much, but if you are interested in the program or have questions on whether or not you have eligible gains, it's certainly something that we're able to help kind of analyze and run through and take a look at. So getting into a little bit of the why now, there has been a lot of discussion amongst legislators and everything as to why the Opportunity Zone program was beneficial or not so much, but ultimately what led to the decision to decouple. So a couple of the biggest concerns were over the census tracts that were designated. So the spirit of this program was really meant to funnel investments to low income, economically disadvantaged neighborhoods or zones that were designated by the state. But I think what a lot of people were seeing is that the areas that were designated were maybe already up and coming, or there was a lot of activity or hype around an area already. So this Opportunity Zone program didn't really seem to meet its intent of targeting those areas. So that was a big concern. Another one that they were seeing was that a lot of existing projects that were already underway, they were either in the development phase or some other stage, but the money was already going into these areas. And now all of a sudden there's this, extra program that they're available for. So it wasn't really in the spirit of the program, which was to spur new investment and development. They saw this program as really being utilized by huge developers who were going to do a project regardless of this program. Again, not really keeping with the spirit. Another thing we saw some discussion about was the Opportunity Zone metrics. So there is not a lot of metrics around this program to make sure that jobs are being created, that the money is being invested how it was intended. All those kinds of things. So that was kind of pointed to as another reason why New York State wanted to decouple, because they didn't really think that the program was gonna hit home where it needed to, as much as was hoped. And then lastly, obviously political pressure. I think one of the big questions with this program still is, is the decoupling from the program going to deter investors to go to other states, presumably more Opportunity Zone friendly states? And what really does that mean for the New York State income and development and all of that? So obviously we don't have that answer today, But as Mark alluded to, there's still unfortunately a lot of questions with this stuff. So another area that there's a lot of questions is in the multi-state considerations. So similar to the PTE, if you have any kind of multi-state component coupled with opportunity zones, or you are looking at investing in opportunity zones, reach out to your tax professional, make sure you have things modeled out, that you understand the timing implications and everything that kind of goes into the multi-state. So, the timing issues, again, if you're a New York State resident, you're going to be taxed on those gains in 2021. But let's say the property was in Pennsylvania, and that's where, your capital gains were realized. Well, Pennsylvania is not going to tax those gains until 2026. So there could be, timing issues between states for recognition of income, which is also then going to lead to a mismatch of state tax credits. You're not paying the tax in Pennsylvania, which means in New York State, you're not getting the credit for taxes paid to other states, and vice versa when it's taxable in Pennsylvania. So there's just a lot of unanswered questions as to what that's going to look like, how that's going to be reported, all that kind of stuff. Hopeful of guidance coming through, in the latter part of this year, and we will certainly keep everyone updated on that as well. But I think the biggest question and issue we saw is what happens if you have someone who is changing residency during this deferral period. So let's say you're a New York resident now, you're paying capital gains tax on it now, and then you move to Pennsylvania, it's taxable in 2026. So now you may be subject to double taxation, and that is a question I don't think we will get guidance on as soon as we would like. But again, it's again kind of the Wild West. So who knows when that'll come out.
Let's just see if we have any questions real quick before we get in the homes. Okay, nothing. All right, so we wanted to point out just these weren't necessarily part of the budget, but just 4 things. I think a lot of what we said is about planning and thinking about what 2021 and ahead is going to look like, and just some things to keep in mind that New York State does not follow the federal on. One is this 163J interest limitation. It was enacted by the Tax Cuts and Jobs Act, essentially limited the amount of interest you could deduct in certain situations. Then for federal purposes, they came out with the CARES Act and made it a little bit more favorable and extended that to not 30% of your adjusted income, but 50%. New York State did not follow that adjustment under the CARES Act. So there's a scenario out there that for New York State, you might be limited, but for Fed, you're not. Just something to pay attention to. The QBI deduction, that 20% deduction that certain qualified businesses are eligible for at the federal level, that does not extend for New York State purposes. Excess business loss limitations, similarly to the 163J, that was part of the Tax Cuts and Jobs Act, and then was suspended under the CARES Act. New York State did not follow that. So if you do have a significant loss from one of your flow-throughs, it's possible that you run into this limitation for state purposes, but not for federal. And lastly, depreciation, specifically bonus depreciation. The federal level, bonus depreciation provides a nice little benefit of 100% deduction on certain qualifying assets that you purchase and put into service during the year. New York State does not follow bonus. It does follow 179. But for those entities that are close to a loss or for other reasons don't want to follow 179, that bonus depreciation could provide a difference between what your taxable income is for federal versus state purposes. And our last polling question, what year was the construction of the Erie Canal completed? Also didn't know this.
Another one I didn't know.
I think everything I learned in social studies and history has gone out the window.
A little place with tax knowledge.
Yeah, that's right. If anyone has questions, feel free to drop them in the Q&A. Time is it? 11:50. So we got about 10 more minutes. So if you have questions, feel free to drop them in there. We'll try to answer them. And if we don't get to them, we'll reach out after. $18.25. Wow.
Which is the correct answer.
This is making me feel very questionable about my intelligence.
Awesome.
Cool. So just to recap some key takeaways, I think number one is planning and analysis. For the pass-through entity tax election, there's a lot of unknowns, but if you have an entity that has a lot of New York State activity and has New York State resident owners, it seems like you're going to want to pretty much make this election. And it's not going to be true in every circumstance, but it certainly sounds like that based on what we know right now. Once you get non-residents involved and you're dealing with a lot of multi-state activity, I think that becomes maybe a little more complicated of a question to answer, or if you have different entities. But certainly if you just have one entity in New York State and you are the sole owner of that S Corp, or you have two resident partnerships of a law firm here and all your work, all your clients are in New York, it seems like that's going to be a no-brainer. But like I said, there's more guidance to be issued and more questions to be answered. But I think the key is work with your advisors, whoever they may be, and make sure you're looking at this. And to Carrie's point earlier, we have until October to really make this election this year. So you get to see almost 9 months of your activity from your entities and make a pretty well-educated decision on this, where next year you're only going to get 2.5 months possibly, unless there's an extension available. So you're looking at 2 months of activity and guessing what the rest of the year might look like. So I think if you're going to spend the time and going to look into this on a holistic approach with all your entities, this is the year to do it. And so the multi-state considerations with the opportunity zone are kind of the same thing. Just be aware of it. I think the examples that Carrie laid out are important. I mean, it sounds like there's a potential where you could get hit with a 7% tax in one state and a 7% tax in a different state later on, eating into your deferral and avoidance really to the tune of 14% if you're not careful. So just taking the time to think through things and making sure you have a plan in place with your advisors. You want to talk about that?
Yeah, and then, just really stressing the importance of year-end planning and income projections as well. The tax rates are what they are. But if you are, on the bubble, really making the tax rate regime work for you is where we can come in, with guidance and ideas on, do we accelerate the acquisition of assets or, delay payments or all that kind of stuff. So one other thing on that PTE modeling as well, we had talked a little bit about cash flow, but it may not really impact cash flow that much. If you're a flow through entity and you are issuing tax distributions out to your partners and shareholders to pay their quarterly payments already, making this PTE election isn't, theoretically wouldn't impact your cash flow that much. So to Mark's point, it kind of seems like it's a no-brainer. If you've got a lot of New York activity, New York partners, New York entities, it definitely seems worthwhile to make this election. But a lot of questions and stuff as well. But we're, like Mark said, we're here for questions and answers. And I believe that our contact information is in the chat as well. So if you guys have questions or think of anything, we're here for any of that. So with that, we'll check in on the Q&A and see if anything has come through. It does not look like it has. But again, Christine's going to send out our contact information if it's not in the chat already. And you can also find us on the Lumsden website if you misplace anything. So again, thanks everybody for your time today. We appreciate your attention. And happy June 16th for anyone with a deadline today.
Take care.
Thanks, guys.